Growth stock. An overview. A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks generally do not pay dividends. This is because the issuers of growth stocks are usually companies that want to reinvest any earnings they accrue in order to accelerate growth in the short term. When investors invest in growth stocks, they anticipate that they will earn money through capital gains when they eventually sell their shares in the future. Understanding growth stocks. Growth stocks may appear in any sector or industry and typically trade at a high price to earnings. They may not have earnings at the present moment but are expected to in the future. Growth stocks tend to share a few common traits. For example, growth companies tend to have unique product lines. They may hold patents or have access to technologies that put them ahead of others in their industry. In order to stay ahead of competitors, they reinvest profits to develop even newer technologies and patents as a way to ensure longer-term growth. Because of their patterns of innovation, they often have a loyal customer base or a significant amount of market share in their industry. Growth stocks versus value stocks. Growth stocks differ from value stocks. Investors expect growth stocks to earn substantial capital gains as a result of strong growth in the underlying company. This expectation can result in these stocks appearing overvalued because of their generally high price-to-earnings (PE) ratios. On the contrary, value stocks are often underrated or ignored by the market, but they may eventually gain value. Investors also attempt to profit from the dividends they typically pay. Value stocks tend to trade at a low price to earnings. Example of a growth stock. Amazon Incorporated (AMZN) has long been considered a growth stock. Amazon stock has historically traded at a high price to earnings. Between June 2020 and September 2021, the stock's P/E has ranged from around 58 to 106. Are growth stocks risky? As with all investing, there is a fundamental trade-off between risk and return. Growth stocks provide a greater potential for future return, and they are thus equally matched by greater risk than other types of investments like value stocks or corporate bonds. The main risk is that the realized or expected growth doesn't continue into the future. Investors have paid a high price expecting one thing and not getting it. In such cases, a growth stock's price can fall dramatically. How do you know if a stock is growth or value? Instead of looking to future growth potential, value stocks are those that are thought to trade below what they are really worth and will thus theoretically provide a superior return, as their stock prices catch up with fundamentals. Unlike growth stocks, which typically do not pay dividends, value stocks often have higher than average dividend yields. I hope this video helped with understanding the growth stock. Thanks for watching.